Breaking news: the White House is now pushing a $2,000 tax deduction specifically for retirees, and this move could have a big impact on your Social Security and retirement benefits. For millions of seniors living on fixed incomes, this deduction could mean keeping more money in your pocket each month, but the real question is, who qualifies and how does it work? With inflation still squeezing budgets, every dollar matters. This new push is designed to give retirees extra breathing room, but not everyone will benefit equally. Understanding how this deduction ties into your benefits and whether it could raise or in some cases even reduce your overall income is critical. In this video, we'll cover why the White House is pushing this deduction now, how it could affect retirees across the country, and what steps you may need to take to make sure you benefit from it. Before we dive into the details, don't forget to subscribe and hit the notification bell so you never miss updates that could directly affect your Social Security and retirement income. The proposed $2,000 deduction for retirees represents one of the most significant tax policy shifts we've seen targeting older Americans in recent years. This isn't just another small adjustment or minor policy tweak that gets buried in committee meetings. We're talking about a substantial change that could affect millions of Americans who are either already collecting retirement benefits or are approaching that crucial transition period in their lives. The timing of this announcement is particularly interesting because it comes at a moment when inflation has been eating away at the purchasing power of fixed-income retirees, and many seniors are finding themselves squeezed between rising healthcare costs and stagnant benefit increases. So what exactly does this $2,000 deduction mean in practical terms? The proposal would allow eligible retirees to deduct up to $2,000 from their taxable income specifically related to retirement expenses and benefits. This isn't a credit that directly reduces your tax bill dollar for dollar, but rather a deduction that lowers the amount of income that gets taxed in the first place. For someone in the 22% tax bracket, this deduction could translate to actual tax savings of around $440 per year. For those in higher tax brackets, the savings could be even more substantial. But here's where it gets complicated: the definition of who qualifies as an eligible retiree and what expenses count toward this deduction could make or break whether you actually benefit from this policy. The political machinery behind this proposal reveals just how serious the White House is about courting older voters ahead of upcoming elections. Have you noticed how retirement security has become a central theme in political discussions lately? That's no accident. With baby boomers representing one of the largest and most politically active demographics, any policy that promises to put more money in their pockets is going to generate significant attention. However, the path from proposal to actual law is filled with potential obstacles, amendments, and political horse trading that could dramatically alter the final version of any legislation. Let's talk about how this deduction would interact with your existing Social Security benefits, because this is where things get really interesting and potentially confusing. Currently, depending on your total income, you might already be paying taxes on a portion of your Social Security benefits. The taxation of Social Security benefits kicks in at relatively modest income levels. If you're single and your combined income exceeds $25,000, or if you're married filing jointly and your combined income exceeds $32,000, you'll owe taxes on some of your benefits. This new $2,000 deduction could potentially lower your adjusted gross income enough to reduce the taxable portion of your Social Security benefits, creating a double benefit scenario. But what happens if you're one of the millions of retirees who currently don't pay federal income taxes because your income falls below the standard deduction threshold? This is a crucial question because a significant portion of retirees, particularly those who rely primarily on Social Security, don't currently file tax returns or owe federal income taxes. For these individuals, an additional deduction might not provide any immediate benefit. However, the proposal might include refundable credit components or other mechanisms to ensure that lower-income retirees also see some financial benefit, though these details remain unclear in the current discussions. The impact on Medicare premiums adds another layer of complexity that many retirees haven't considered yet. Medicare Part B and Part D premiums are based on your modified adjusted gross income from 2 years prior, and higher income beneficiaries pay significantly more through income-related monthly adjustment amounts, known as IRMAA. If this deduction successfully lowers your reported income, you might find yourself in a lower IRMAA bracket, which could save you hundreds of dollars per month on Medicare premiums. Are you currently paying IRMAA surcharges on your Medicare premiums? This deduction could potentially move you into a lower income tier and reduce those monthly costs substantially. State-level implications vary dramatically depending on where you live, and this is something that many retirees overlook when evaluating federal tax changes. Some states conform to federal tax law changes automatically, meaning that a federal deduction would also reduce your state tax liability. Other states have their own separate tax codes and might not recognize federal deductions, limiting the benefit to just your federal tax bill. If you're living in one of the states that doesn't tax retirement income at all, like Florida, Texas, or Nevada, then obviously the state-level impact is irrelevant. But for retirees in high-tax states like California, New York, or New Jersey, the combined federal and state savings could be substantial. The timing of implementation raises important strategic questions for current and soon-to-be retirees. Will this deduction be available for the current tax year, or would it only apply to future tax years? The answer could influence major financial decisions like Roth IRA conversions, timing of retirement account withdrawals, or even the decision of when to claim Social Security benefits. If you're planning to retire within the next year or two, should you accelerate that timeline to take advantage of this deduction? Or conversely, if the deduction won't be available immediately, might it make sense to delay certain income-generating activities until you can benefit from the tax break? Congressional approval represents the biggest hurdle facing this proposal, and the political realities in Washington suggest that the path forward won't be smooth or predictable. Even if there's broad support for helping retirees, the details of how to pay for this tax break, which programs might be affected, and how it fits into broader tax policy discussions will likely generate significant debate. Have you been following the budget discussions in Congress lately? The current fiscal environment makes it challenging to pass any legislation that reduces tax revenue without identifying offsetting spending cuts or revenue increases elsewhere. The long-term sustainability of Social Security and Medicare adds an interesting dimension to this discussion that goes beyond just the immediate tax benefits. Some policy experts argue that providing additional tax breaks to retirees without addressing the underlying funding challenges facing these programs is essentially borrowing from the future to provide present-day benefits. Others contend that helping current retirees maintain their purchasing power is an immediate necessity that shouldn't be held hostage to longer-term structural problems. What's your perspective on this balance between immediate relief and long-term program sustainability? For financial planning purposes, the uncertainty around this proposal creates both opportunities and challenges. Should you adjust your retirement savings strategy based on the possibility of this deduction becoming law? The conservative approach would be to continue with your current planning assumptions and treat any eventual deduction as a bonus rather than a fundamental component of your retirement income strategy. However, for those who are right on the borderline of different tax brackets or Medicare premium tiers, even the possibility of this deduction might influence optimal timing for major financial decisions. The ripple effects throughout the retirement industry could be significant if this proposal becomes law. Financial advisors, tax preparers, and retirement planning software companies would all need to update their tools and strategies to account for this new deduction. Insurance companies offering annuities and other retirement products might adjust their marketing approaches and product features. Even employers offering retirement benefits might need to update their employee education materials and planning resources. As we wait for more details and congressional action on this proposal, the key takeaway for retirees and pre-retirees is to stay informed but avoid making major financial decisions based solely on preliminary proposals. The final version of any legislation, if it passes at all, could look significantly different from what's currently being discussed. Keep detailed records of your retirement-related expenses, stay engaged with the political process, and work with qualified financial professionals who can help you adapt your strategy as new information becomes available. This $2,000 deduction proposal represents just one piece of a much larger conversation about retirement security in America, and regardless of what happens with this specific policy, the underlying challenges facing retirees aren't going away anytime soon.